It's going to be a relatively quiet week on the macroeconomic front, with Chinese trade figures on Wednesday the 11th, an interest rate decision from the Bank of Canada also on the 11th, and the minutes from the last European Central Bank meeting on the 12th, the only real points of interest. On the company front though, a good number of FTSE 100 and FTSE 250 members are due to release results, a trading statement, or host their annual general meeting for shareholders. They include BT, Burberry and recruitment specialist Page Group on Wednesday the 11th of July, real estate investment trust Land Securities, retailers Dunelm and Assos on the 12th, and, lucky for them, marketing and support services group DCC, credit checker Experian, recruiter Hayes and emerging markets fund manager Ashmore on, yes you guessed it, Friday the 13th of July. However, the company most likely to cause a fuss in the week ahead will probably be FTSE 100 house builder Barratt Developments when it unveils a full year trading update on Wednesday the 11th of July. As we can see here, the shares are trading at their lowest level since February 2017, even though we're constantly hearing about housing shortages, strong house prices, and the government's desire to help would-be purchasers with initiatives such as Help to Buy and the Lifetime ISA. This share price weakness is mainly due, I suspect, to cautionary comments from sector peers Crest Nicholson and Barclay. Both have talked of rising cost pressures, and Barclays even suggested its profits could fall by up to a third next year, thanks to macro uncertainty, weakness in London and the South East, and those cost pressures. Now, Barratt's got a broader geographic spread than Barclay. Just a quarter of Barratt's sales last year were in the south of England, and it also has a different customer mix, with around 35% of last year's completions going to customers who were using the Help to Buy scheme. It'll therefore be very interesting to hear Barratt management's take on the UK housing market. The key numbers to watch, well, they'll be as follows. Total forward sales will be the first. They were £3.3 billion as of a trading statement on the 10th of May. At the final stage last year, forward sales were £2.8 billion. Then look at pre-tax profit. This will be driven by volumes, prices and costs. Completions last year came to 17,395 dwellings at an average private selling price of £313,000. An operating margin of 17.4% actually lagged that of Barratt's peers, who are all making more than 20%, so analysts will be looking for progress there, as the consensus estimate calls for pre-tax profit of £811 million against £765 a year ago. For the year that's just beginning, the consensus forecast is £852 million. Watch out also for commentary on forward pricing and particularly cost pressures. And then the third thing to look at, well, that's the dividend. Last year, Barratt paid a regular full year dividend of 24.4 pence a share and a special of 17.3 pence for a total of 41.7. This time around, analysts expect a total payout of 43.3p a share as Barratt uses the net cash on its balance sheet. On a share price of around £5, that's enough for a yield of 8.6%, although the share price weakness may suggest investors are wondering whether this can be sustained in the very long run. This final graphic shows how the Barratt estimated forward yield for 2018 compares to the yield offered by its FTSE 100 and FTSE 250 rivals. Thank you for watching, and I look forward to seeing you next time.